Have you ever wondered how a huge company, with all its moving parts, keeps track of every single thing it owes? Well, today we're going to demystify one of the most fundamental concepts in finance, liabilities. We'll break down what they are and why they're so incredibly important for any business.
So let's start with a practical thought experiment. Just imagine a massive corporation. It's got thousands of employees to pay, tons of suppliers sending invoices, maybe a few bank loans. How in the world do they keep all of that straight? Well, the answer to that puzzle is all about understanding and managing liabilities.
All right, here's our game plan. We're going to start with the basics. What are liabilities? Then we'll go on a little hunt to find them on the balance sheet. After that, we'll cover the different types, see how one is actually created, and then we'll wrap it all up with the key things you need to remember.
Okay, first things first. What exactly is a liability? You'll see the Polish term here, zobowiązanie, but don't let the new word fool you. The concept is actually pretty straightforward.
You know, the easiest way to think about this is to just look at your own life. Your credit card bill, your rent, your cell phone bill. That's all money you owe for stuff you've already used, right? Those are your personal liabilities. For a business, it's the exact same idea, just, with a few more zeros at the end. Now for the textbook definition. A liability is a present obligation, which just means the company owes something. It comes from a past event, like say buying supplies last week, and settling it means an outflow of economic benefits, which is really just a fancy way of saying they have to pay up, usually with cash.
And this is so important to get. A company's health isn't just about how much money is coming in. It's also about how much money has to go out. Keeping a close eye on these debts is absolutely essential for a business to stay afloat.
Okay, so we know what liabilities are, but where do they actually live in a company's financial records? To find them, we need to look at one of the most important financial statements out there, the balance sheet.
So here it is. This is a balance sheet. Think of it as a snapshot of a company's financial position at a single point in time. On the left side, you've got activa, which means assets. That's all the valuable stuff the company owns. And the golden rule here is that both sides of the sheet have to be perfectly equal. They have to balance.
Now, let's shift our focus over to the right side, under the big heading passiva. And there they are, zobowiązania, our liabilities. This whole right side basically tells a story. It answers the question, how did the company pay for all the assets on the left?
And what's really fascinating about this passive side is that it shows exactly who has a claim on all the company's stuff. It's broken down into two groups. What the owners themselves have invested, that's called equity, and what the company owes to outsiders. And that right there is our liabilities.
Okay, so let's dig a little deeper, because it turns out not all debts are the same. We can split liabilities into two main categories. Really, it all just boils down to timing. You have short-term liabilities, or krótkoterminowe, which are debts that need to be paid off within a year. Think of things like bills from suppliers or employee paychecks. Then you have long-term liabilities, długoterminowe, which are due more than a year from now. A classic example is a big bank loan taken out to build a new factory. And trust me, this distinction is critical for understanding if a company can actually pay its immediate bills.
I know this can still feel a little abstract, so let's walk through a real-world example of how a liability is actually born from a simple, everyday business transaction.
So it all starts with something like this. A company orders some parts, and the supplier drops them off at the warehouse. The second the company accepts that delivery, even before any money changes hands or an invoice is even looked at, an obligation has been created. The company now owes the supplier money.
This is where that real-world event gets translated into the language of accounting. Now, this diagram might look a little complicated, but all it really is a system of checks and balances, debits and credits, to make sure that every single transaction is recorded perfectly. And here is exactly how it works. The invoice comes in, right? The accountant doesn't just write down the total. Nope, they break it down. They record the value of the goods themselves, then they account for any tax, like VAT, and then they add it all up to get the total gross value. And that total amount is what officially becomes a liability on the company's books.
Whew! Okay, we have covered a lot of ground, from the big picture ideas right down to the nitty-gritty details of an accounting entry. So let's zoom back out and recap the most important things to remember. If you only take away 4 things from our chat today, make it these. Number 1, liabilities are just what a company owes. Simple as that. 2, you'll always find them on the right-hand side of the balance sheet. 3, the big difference is timing, short-term versus long-term.
And finally, number 4, they're created all the time from just normal day-to-day business.
So I want to leave you with a question to noodle on. Think about all the different kinds of debts a company might have. Money owed to suppliers, salaries for employees, taxes, bank loans. Which of those do you think is the most critical to manage, just to keep the lights on and the doors open every single day? It's a fun question to think about. Thanks so much for joining me for this explainer.